G'day. Welcome to the Pumped on Property Show podcast. Now today, I'm going to be here with Simon. We've printed out a shitload of stuff for you today from all of our favorite authors and analysts around the world to give you the deepest possible market update. Now, whether you're driving in a car, on the train, commuting, training at home because we can't train in gyms anymore, or you're sitting down listening to this with your partner, make yourself a cup of tea, grab yourself a drink, and let's get into it. Now, uncertain times have been behind us over the last 6 weeks. It's been quite fearful. The media is really hammering people at the moment, and it's got to the point where, I'm waking up most days actually feeling a little bit sick. I'm sure you're feeling the same way, and that's why today we wanted to talk about not just what's going on right now, but what's happened for the last 200 to 300 years during this particular time in the cycle, so that you can start to separate the fact from the fiction, and you can start to get yourself in a position where you're not just feeling petrified like the world's going to end, because it's absolutely not. And you can start to build that confidence that we have to continue to move forward in the direction of your dreams. And for some of us, it's going to be the most incredible buying year of the last decade. For other people, it's going to be a very, very stressful and uncomfortable economic time. So we all have a choice, and the choice that I've decided to make with my wife is to step up, to move to a different energetic level, to be the highest and best version of myself, even though moment to moment I'm trying to manage that at the moment. Had a bit of a stress out this morning talking to Simon, but just got to shake it off and continue to move forward in the direction, because I don't want to be low frequency for the next year. I don't want to waste a year of my life, my kids' lives, my family's life. I want to get on with my business. I want to continue to help you guys and continue to move forward.
Yeah, with these uncertain times, everybody's going to be in that situation. Everybody's going to be feeling those emotions, and you've really got to start working through them and figure out how you can get on with your life in the best possible way. And as you said, not hold back. And what I've done is just turn off the news and focus on more credible resources as opposed to Channel 7, 9 and 10.
Yes, I'm the same. The only news that I've been following now is the Prime Minister's daily updates, because with him and his chief of medical staff, I feel more certain that I'm getting the right information. I've got also a really good link to an accountant who's sending me very, very good information about the stimulus and the recovery packages that they're bringing on, which we'll talk about in this plus future podcasts in a lot more detail, just so that you've got some certainty and a better understanding of that stuff. And, ultimately we all have a choice. So I was feeling a bit anxious and a bit overwhelmed this morning. Now, for me, that's because this is an old triggering story. I've been reading about market collapses basically every week now for the last 5 years. I've read all of Phil Anderson stuff, Fred Harrison stuff, Ray Dalio stuff, Warren Buffett stuff. I follow a lot of people in this space, and, they constantly talk about and educate me about cycles. And so this is a triggering time for me, and I'm sure that the lizard part of your brain is triggering you at the moment. So hopefully by the end of this, you start to feel a little bit better. Hopefully you can create a plan in place. Hopefully you can use this period of self-isolation for improvement, for gaining knowledge, for booking strategy sessions in with people like myself, so that you can learn more. You can put a plan in place to protect yourself and your family. And in future videos that we're also going to record this week, we're really going to get stuck into how I've just saved 40% of the costs in my life, how Simon's reducing his costs. We're going to talk about mindset in stressful times and the daily practices that we're putting in place. And we're going to just help you all the way through this year, not just survive it, but for those of you in strong financial positions, absolutely crush it and buy some of the best properties that you'll ever buy in your lifetime. So let's get stuck into it, man.
Yeah.
This first one is from the man, Phil Anderson. Now, if I hadn't read Phil's book 4 years ago, I would be freaking the absolute F out right now. I would be so scared.
100%.
But I've been getting weekly, even daily updates sometimes from Phil now for 4 years. And he told me in 2018 to start working on cash flow, to improving my cash flow position, to selling any unnecessary assets, and to build a safety net. And he said that by March 2020, the world would be in the deepest mid-cycle slowdown in the last 100 years. Now, imagine you knew that was coming for 2.5 years, and instead of this being a surprise 3 weeks ago, you were accurately prepared.
And you've been producing videos, releasing content since 2018, talking about the larger cycle, which we'll definitely get into today, and also these mid cycles that we're going into at the moment. So it's not brand new news to us, obviously unprecedented times, but one thing that we do notice that Phil has educated us on through these articles that we're just about to tell you about is every single mid-cycle slowdown has come on in a different sort of way, and then this particular virus is just the way that it came on this time around.
Yeah, it's one of those things where, you know, it was time for it to come, and we'll talk about that a lot more detail as we go through this. But, you know, the virus has not caused this mid-cycle slowdown, and this is what we'll talk about a lot more as we move through this video. So I don't think there's any way to do this but sort of walk through the major commentary from these people, and then at the end of it, we'll sort of wrap it up and interpret it in terms of what it means for you and I.
Yeah.
As you can hear, I've got the kids upstairs, I've got the animals upstairs. So it's going to be a bit noisier.
Tradies outside.
Tradies out the back, finishing off the backyard, which is looking sick. Sort of feeling a bit sick that I spent so much money out there now. It would have been nice to have that money in a buffer, but if I'm going to be self-isolating, it may as well be in my own little oasis out the backyard.
Exactly. I think this first point is so important, which basically breaks down Fred Harrison's book. As you said, you've read it before, Boom and Bust. If you haven't read it, go out there, buy these books. Fred Harrison, Boom and Bust, Fred Harrison, The Power in the Land, Phil Anderson, The Secret Life of Real Estate and Banking. Wrap yourself around these cycles, especially when you've got a little bit more time on your hands at the moment sitting at home.
So Boom and Bust looked at the UK property and stock markets and business cycle back to the 1600s. This has been going on for literally 350 years. And then Phil Anderson's book looks at 250 years of this stuff in America. Now, what's important mainly about Fred Harrison is that he released Boom and Bust, calling the 2007 GFC in 2005. He printed it. He also wrote The Power in the Land in 1983, calling the 1990 recession that we had to have. So these are guys with a 40-year track record of actually calling stuff before it happens. And that's why getting access to the right people in these times is so important. And that's why I've been religiously following Phil's and Fred's videos over the last 2 years. Now, what they both mentioned is that since the 1990s, with the fall of the Berlin Wall and the rise of China, this cycle has now become a global one. So in the past, it was more of like a UK, American and Australian cycle. Basically anything that was in the, what do you call it?
I would call it localized. So localized markets, localized economies.
The Western markets that were still like driven by a king and queen type vibe, you know what I mean?
Exactly. But as we move into this more global world, which has especially come into more fruition from the 90s forward, we've got this global world, so we've got this global economy now, and what that provides the opportunity to is bigger growth throughout these times, and also bigger busts when they come as well.
Yeah, so what Phil said, and these are his direct words. Now, I recognise that some people aren't going to vibe with everything that we're talking about today. We're going to be talking in their language. You know, I don't have an opinion on anything. I'm just trying to bring the best information to you. But he said, let's put some perspective into what's happening right now. Current events are a total emotional overreaction, but it was due and it had to happen. Now, what's happened is that since the GFC, we've got ridiculous amounts of cheap money and easy credit, easy money. That cheap money and easy credit has gone straight into land values around the world's biggest cities and straight into the stock markets, to the point where we get to now, and imagine the stock markets were to go up by another 200% in the next 10 years, how overinflated they would be compared to business valuations. Or imagine prices in Sydney in the next 7 years doubled again. People would not be able to afford them. So we get this middle point where the banks go, holy shit, we've lent out too much easy money. The economy's sort of working again, and people freak out at this time. Now, he goes on to say that your key takeaway from this email is that the events of 2020 were due, they were going to happen, so let's put some perspective into that. And it's just, maybe not what every one of us want to hear, especially if it was the first time that you've heard about this stuff, but it's necessary to know this stuff so that next time it happens, you can be better prepared. Or this time around, if you're in a good financial position, take advantage of it.
Yeah. And, we are talking to the people that are in a great financial situation at the moment. We understand that lots of people are losing their jobs, that that the unemployment rate is climbing extremely high. So as Ben said, this is just other words that we're relaying to you to help you understand, navigate through these times as best you possibly can.
Now, Phil goes on to say that the cause of the recent panic was not the virus. We've got two different messages going on. And for anyone that heard the Prime Minister's address last night, what was the date yesterday? 24th of March. He basically said we've got two crises. We've got one that most people that don't understand the economic cycle are focusing on right now, and that is the health side of this, which is horrible. 50, 60 million people around the world are going to probably die from this virus by the end of it all, based on, 1 to 3% of the world's population passing away. That is just horrible. And I feel for those families and those people. But for the first time on television last night, he addressed that there's an economic issue here as well. And I think people have been fascinated and obsessed with and fearful of this media in the last 6 weeks, which has been the pandemic. And I think once that becomes a message that people can't hear anymore, or once we've sort of sorted it out, the next message for the next 2 to 12 months from today that you can expect to start coming through louder and louder is the economic impact of this globally. We'll talk a lot more about that. He said the cause was the prior decade run-up in asset markets, the creation of easy credit, the increase in debt, and most importantly, the prior large rise first half of the cycle in land and asset values. Now, we get to this point because everything's artificially inflated. Now, when the number one trader and number two trader of all time, number one being Ray Dalio, number two being Warren Buffett, have been coming out since mid last year and saying that they have gone into cash because the markets are dangerous to them, that is like a hell of a sign that, something horrible is coming. And that's why we've seen the Australian stock market drop by 36 to 40% in 2 weeks, and we've seen the American markets drop by 36%. We will also talk about this later on in the video about how normal that is at this time of the cycle, although this drop has been deeper and faster than it has been at any point before, and it may go deeper than the average mid-cycle because of the things that we're having to put in perspective that are slowing the economy further at the moment. Now, he goes on to say, because the owners of government can simply not afford another crisis, nor can they afford yet another collapse so soon after the last one, or a revolt by the working class, they will do everything they possibly can to bail us out right now. That includes $100 billion of funding to the banks in Australia right now to help tenants that can't pay their rent, to freeze mortgages, to support people that are going to be in very strong financial distress, as well as $77 billion worth of stuff for low-income earners, pensioners, mums, business people, and everyone else in the economy to get the stuff going again. Now, that represents a ridiculous amount of our GDP. The UK has just put in 20% of their GDP in terms of a bailout plan. America's putting in trillions of dollars to get themselves out of it. And right now, this is what they can do. This will be the biggest mid-cycle slowdown bailout of all time. And what that's going to do, according to Phil, is result in getting us out of this sooner rather than later, but also creating a ridiculous run-up in asset prices later down the track.
What you got to remember is that just as much as the government, business owners, everybody in the world doesn't want this to happen. So the governments have obviously put their front foot forward and said, okay, well, we're just going to pour as much cash as we possibly can into this right now to try and ease the impact that it's going to have on the average person. And once again, unprecedented.
And that's what's scary about these times, is that we have gone through similar things before, but we haven't had a health thing like this since the Spanish influenza 100 years ago.
Yeah.
So it's extreme. Now, Phil goes on to say, it's the mid-cycle. If you're new to markets and you're seeing this for the first time, and if you don't know your history, then watch and learn. If you have been following his information, then this is nothing new. Now, he goes back to look at other mid-cycle points, because this has happened for 250 years in America and 350 years in Europe. In 2001, we saw 9/11. We saw the dot-com boom and bust. That was the mid-cycle slowdown. At that point, the stock market corrected by over 40%. In 1981, Paul Volcker at the Fed Bank of America lifted interest rates to unbelievable levels of over 15%.
And I'm sure a lot of you remember these
Paul
times.
Volcker, I think. I don't know who Paul is. I'm not sure if he's a guy from Australia or America, but I know that the Australian interest rates went to unbelievable levels, 15%, to kill off inflation.
And I'm sure you know somebody in your life that had a parent, an auntie, an uncle, a cousin, or yourself bought properties, their first properties probably in the early 90s, and were paying ridiculous amounts of interest on those properties. So they're the kind of times that we're talking about. So that was the onset of the mid-cycle slowdown before that.
I remember mum and dad saying at one point that interest rates got so high that, like, dad obviously used to love having a beer, and he would have the change left over from the mortgage repayments and food, as well as school fees, and he'd go up to the bottle shop with that change and
5 cent coins,
one long neck, a week or a fortnight if he could afford it. Now, punters said the US economy would never recover. That was the mid-cycle slowdown in 1981. Now, in 1961, a credit squeeze seemed to come out of nowhere. That's when they stopped giving credit. We saw the same thing in the GFC, followed by the Cuban Missile Crisis. Everyone said the world was going to end. That was also the mid-cycle slowdown. So you've got 9/11 and the dot-com boom. You've got interest rates going to 15%. You've got the Cuban Missile Crisis. Now you've got
the coronavirus.
And you've got to remember that it's always something different that triggers it, but it's always around the same stage of the cycle, because what happens is cheap money goes in, it artificially inflates prices, something damaging or disruptive comes up, scares people, and they run away from the market because the fear was already there. Now, the next person that we started to have a look at is Catherine Cashmore. She basically took over writing for Phil Anderson at Port Phillip Publishing. I'm really, really enjoying her weekly updates at the moment and quarterly reports. Extremely good quality information getting sent to us. She also understands cycles. She's a buyer's agent down there in Melbourne. Got no idea what type of work she does as a buyer's agent, but she's a great writer and she's a great analyst. So she talks a little bit about an email that she sent to me earlier this week about the health impact of the virus, which Simon and I are not doctors, follow the Chief of Medical Staff's advice around that. But what governments are doing, which we're all aware of now, is, we know that this virus is going to go through society. They're just trying to slow the spread so they don't get a run on the hospitals, like people, in the 1900s used to run on the banks, they called it, where people freaked out in these times, went and withdrew all their money, and that's what created these types of events back then. She's saying that she's been doing some overlays of the S&P and ASX charts, and from overlaying information and sort of projecting what's happening now, it's not unlikely that we could see as much as a 50 to 60% decline in the S&P, as well as a 40 to 50% decline in the Australian stock market during this time from start to finish. Now, it may even get worse than that before it gets better. Who knows? This is just her overlaying the information that's been occurring now and where it could potentially go based on different scenarios.
And the good thing about Catherine is she did go in a little bit about the property market as well and what's happening. And obviously with the new implications of social distancing and certain businesses being able to operate, there's no longer any open for inspections. There's no longer any auctions that are going to take place. So
in the way that they used to.
Exactly.
That means groups of people rocking up together at an auction, but every auction that I've ever attended has been over the phone or on Skype.
Now, I've been on the phone to probably 4 or 5 different real estate agents from Brisbane this week, and especially the people that we work really closely as well, our property managers. We've been getting regular updates. Now, they've already completely changed their business model, and all of them are going to private inspections. All of them are figuring out ways to make sure that they continue to work and they can do their very best to continue as business as usual.
What's important here is that for the last 5 years in this business, we've actually never attended a single open home or a single public auction because it's an absolute waste of time going and showing up when other people are there. We've always done private inspections. So I suppose the rest of the industry is just going to recognize that they waste a lot of time doing that, and it's going to evolve to one-on-one inspections where obviously, that's the way that works. Now, what Catherine went on to say is that the supply of new land and new lots is already dropping. Now, this isn't just dropping as a result of the coronavirus. This has actually been dropping for the last 3.5 years as a result of APRA making it really difficult to borrow money. And you have got to remember that if it was hard for you to borrow money in the last 3.5 years, it's been way harder for a developer looking to do a bigger project. So what's happened is we've had 700,000 new Australians move here from overseas in the last 2 years, but we haven't created the amount of land supply. Now, in Sydney and Melbourne right now, there's probably an oversupply of inner city units just because they oversupplied that product. But in a lot of other areas, particularly good quality parts of Brisbane, we've been seeing vacancy rates drop by 0.5% to 1% in the last 3 months alone. It is chronically undersupplied from a rental perspective at the moment.
And to continue touching on those properties, what we've found over the last 3 months as well until just recently is we're not seeing as many properties coming onto the market, but there was a huge influx of buyers as well, and that would have occurred down in Melbourne and Sydney as well. And that's where you had this short-term property run over the last 3 to 6 months that has kind of come into because of the fact that there's an over demand compared to the supply.
Now, that was also, particularly in Sydney and Melbourne, people thinking it represented a buying opportunity, which I've been saying for 2 years, it doesn't. It was called FOMO. What happened in Sydney and Melbourne wasn't just the demand and supply thing. It was sentiment and people thinking that just because Sydney dropped by 15% and just because Melbourne dropped by 10%, they represented a buying opportunity without looking at what happened in the last 10 years, which was prices going up almost double during that time. Now, Catherine goes on to say that there's not one Australian market. There's Sydney and Melbourne, which are grossly overinflated right now, and the demand is going to subside, and that is going to result in a flattening of prices in the short term. And then you've got places like Brisbane that are cheaper to buy than they were 12 or 13 years ago. Perth that was cheaper to buy than 14 years ago now. You've really strategically at this time not got to read the mass media and go Australian property, but go which pockets actually represent value and which areas based on the second half of the cycle historically do better. Now that's regional markets, it's markets connected to the major cities, and it's the secondary capital cities like Brisbane and Perth historically do a lot better than Sydney and Melbourne over the next stage of the cycle.
It's really important to understand that Australia isn't just one big cycle. There are certainly cycles within cycles, and the most recent runs down in Sydney and Melbourne in the previous years from 2011 onwards to 2016, they had an amazing run where a lot of other markets in Australia sat quite flat through those periods of time. So you've got to really remember that cycles run within cycles, even when it comes to a particular market. Let's talk Brisbane. There's also markets within that market. So high quality areas, existing suburbs that are fully established already that have high owner occupier appeal, avoiding brand new off the plan units, avoiding house and land packages 60 kilometres from the CBD, making sure that you know what the best asset in that particular market is to be focusing on at any given time.
I love that, bro. Like, it's completely true. Now, if you actually understand Brisbane, for example, well, if you listen to me and you heard me say based on CoreLogic's data that Brizzy's cheaper to buy than it was 12 years ago, that's as a whole. There's some suburbs in Brisbane that have grown by less than 1% for the last 10 years. There's other suburbs within 5Ks of the city that have done 80 to 90% growth in the last 10 years. So this is what I love about Brisbane. You've got like these suburbs that have done 80% growth in 10 years, these that have done 40, and then this one sitting next to it that's done like 15%. And it's very disjointed, where Sydney and Melbourne, the rising tide lifted all boats because it went broad. Now, Catherine goes on to say, it's not all doom and gloom into the future. And I want you to hear this. We will get through this time. And in a year and a half from today, it will just be a really, really difficult time for a lot of people and an incredible opportunity for some of you. She said, remember that the roaring 20s followed the Spanish flu 100 years ago. Now, that's really, really important to note, because the Spanish flu was also at the mid-cycle slowdown point. And then we had the 6 or 7 year run after that, which was the roaring 20s, which was the strongest bull market of all time, which obviously led us into the Great Depression, which was the hardest recession of, it actually wasn't, it was like the third or fourth worst in the last 300 years. But again, we've got like a limited memory on what happened before the Great Depression. You know, there was a time in the 1890s where stock markets and property markets around the world dropped by 90% after the mining collapse, which was gold mining. So the government, she goes on to say, has to make a decision to either sacrifice economic growth or protect our population. Now, it's completely clear that the government has to protect our population, and that is what they are doing all around the world. She goes on to say some things that have already happened. She basically says that she thinks all countries will go into lockdown, and that's what we're starting to see. India's gone into lockdown overnight. I think Australia's a week or two away from that at the moment.
I think it's interesting to point out as well, because we're talking to people that are predicting the future. We received this information last week, and she's actually pointed out a few things that have now actually come into fruition, which is like pubs and clubs not being able to open, places that are eventually going to go into lockdown, etc.
Now, she quotes a guy called Vimal Gore, who's Pendle's head of bond, income and defensive strategies. He said that I think virtually all countries will go into lockdown, Australia included, and this will result in a global recession that will force governments into massive fiscal stimulus and response. I'm talking maybe 20% of GDP or more. Now, this has obviously come into fruition because we're seeing the UK, America, Australia all getting close to that 20% mark now. We're about to experience the biggest government bailout on record. Nothing appears to be off the table. They will throw out the rule book. This is war. This includes huge purchases of treasuries, US bonds, corporate debt, and household debt to stop a banking crisis. We also expect numerous rebates along with relief from GST, income and payroll taxes in Australia. Ultimately, all of this activity will feed into a massive boom the likes of the world has never seen, and land prices will eventually take all of these gains. History over the last 250 to 350 years teaches no clearer lesson. Now imagine while you're seeing the ads or watching a current affair tonight, you've also got this information coming into your inbox. And this is why I do feel sick, because I feel sick for the people's lives that are going to be lost. I feel sick for the hard decisions I've had to make on my own life, my team's life this week. But I also feel like it is an incredible opportunity if you're in a financial position that is stable, which so many people are. We work with so many doctors, so many nurses, so many people in defense, so many people in police, AMBOs. We work with a lot of professional athletes. We work with a lot of engineers. We work with a lot of people in construction. We work with a heap of people in the IT industry. We work with people all over the world with solid businesses. We work with mum and dads that have been doing nothing but save money and get growth on their assets in Sydney, Melbourne, Brisbane and Perth since the last GFC. We know that so many of you, like myself, have been stacking cash for a rainy day, and this is the rainy day. Now, from talking to 8 people yesterday on the strategy sessions, and our strategy sessions have been booking out so far in advance at the moment. So if you want one of them, please jump over to the website. If you can't find a time, because so many people have been waiting for this market, then send us an email, which you can jump onto our website, www.pumpedonproperty.com, and click the contact form. Then send us an email and Simon or myself will give you a call. We'll learn a bit more about where you're at and we'll find a time to slip you in. This is going to be a time of major opportunity. Now, Simon, let's go through the RP Data update, which RP Data is Australia's leading property analyst. Tim Lawless is, I think, Australia's most conservative property author, and I absolutely love him for that.
Yeah, 100%. So this one was actually written by Eliza Owen, one of Tim's colleagues, breaking down what their thoughts are on everything that's occurring at the moment in Australia.
So she's basically said that amid the spread of the coronavirus, the past few weeks have seen an increased expectation of an Australian recession. Now, a recession is just negative growth.
Yeah.
The whole economy is based on consistent growth, and it's like life. There's summer, there's winter, there's spring, there's autumn. We're in a winter period right now, which for some people is a time of freaking out because they haven't spent summer gathering the berries to survive this winter. For other people that have been storing those berries away, winter becomes an opportunity to rest, recover, to reset, reflect, and to start the process of getting set up for the next expansion. Now, a slowdown in business activity and trillions of dollars wiped off the global share markets. It has many people asking what the impact of the coronavirus will be on the Australian property market. Now, we're finally going to get quarterly figures of all the companies around the world very soon. We're also going to get quarterly figures from GDP, from Australian government. We're also going to get the quarterly figures of the property market as well as the March figures, which is the true figures of what's been happening sentiment-wise. But we already know that auction clearance rates are going down in Sydney and Melbourne, which is good. They were freaking ridiculous again, sitting at 70 to 80%. This article is kind of interesting. We'll talk through it.
Yeah, so basically what Eliza's broken down is housing has actually performed relatively well against economic shocks, but the unique conditions of a pandemic-induced economic slowdown must also be considered. You've got to remember that housing is an illiquid asset and a consumption good, which shows far less volatility and decline than the share market. In the coming weeks, property transactions will fall significantly, but the impact on values is still unclear. So it's really important to understand. She also goes on to say that existing economic headwinds, including high household debt, make the property market particularly susceptible to a fall in demand. However, Australia does not have one property market, as we were saying before. A decline in demand will be tempered by the composition of the local workforce and the state of household finances.
Now, I wanted to talk through this next bit because it's important for those of you who haven't seen this type of event or read about it before to understand what's happened in the past. Now, in these mid-cycle slowdown points, and I'll talk about this a lot more in other videos, we generally get between a 0% decline in house prices to about a 15% decline on house prices around the world. But during these mid-cycle points, we normally get somewhere between a 30 to 40, sometimes even 45% decline in the stock markets, including the ASX and S&P. Now, that's important to note. Now, the difference between a mid-cycle point and an end-of-cycle point historically has been the end of cycle is when we're all in. And generally at end of cycle, we get an average fall on property prices globally between 38 and 48%. That is a halving of property prices around the world. And that's what happened around the world in the GFC. The Australian government just bailed us out of that, as did the Canadian and Swedish governments. And you get a fall at the end of cycle in the stock market of between 50 and 60%. Now, that's really, really important to note because it means that these things have been consistently happening. Now, in the start of the video, we talked about the last 3 mid-cycle points, and in future videos, I'll show you how the markets have dropped during those times by between 30 and 40%. It's important at the moment with fact and fiction because I saw an article the other day on one of the major news channels that Australian stock market had its worst day on record, dropping by 9.5%. Then I read this article from RP Data, and they said in 1987, Black Monday, the stock market crashed by 23% in a single day. Now, you've got these journalists that can't remember any of this shit, and they're not economic professors, they're not reporters, they're not investors, they're just people that are sensationalizing these things to make it feel worse than it is. And I understand if you were going to retire this year or in the next 5 years and you've just had 40% of your superannuation wiped out from under you, like I feel for you, like it's absolutely horrible. I was in an event last year with Phil Anderson, and him and Amid, who's his business partner, got on stage. They said that if you aren't out in cash right now, pull absolutely all of your money out of stocks and super into cash, because the risk is not worth the reward at this time. Now, that was 6 months ago. You know, it's really, really unfortunate for the 95% of people that don't go to those events, that don't watch these videos, that don't listen to these podcasts, to not have this information on hand earlier. On the flip side of that, I've got clients all around the world that have been buying, for example, like American Airlines at 42 cents in the dollar. Like, you know, Virgin Australia is going to, you know, this morning or very, very shortly sack 80% of its staff. Like, that stock market, that share price is going to take an absolute flogging from that, with every single plane grounded. Unfortunately, in these uncertain times are unusual opportunities as well.
Exactly.
Imagine you picked up your stocks at 50% below market value before the end of the year. Over the next 5 to 6 years, those stocks increased in value by 100, 150% like they historically have. And then you sell them out before the next 50% decline and you buy again at the bottom. Or imagine you don't, and you just consistently trade the market and you can still get your 7% per annum over the next 30 years, because that's what it's historically done. You know, you don't have to be an in and out trader, but there's big opportunities, what I'm trying to say. Yeah.
And you got to remember that most people have a short-term outlook, that fear sells more, gets more, sells more newspapers than positivity. So, you know, it's going to be negative for a while out there. So you've got to try and find the right information, find the right resources if you are in a good position to be one of those people that can make opportunity out of these bad times.
Yeah, one absolute saving grace in Australia, which I am so grateful for, is that when things were getting really bubbly with the property market in 2014, obviously, APRA stepped in and they recognised that the banking industry was out of control and they were lending too much money and speculating. I heard at one point Commonwealth Bank was the most profitable bank in the world. It was more profitable than Warren Buffett's bank. You know, now Warren Buffett's not running CBA. There's, you know, that's a problem. APRA stepped in and effectively made it ridiculously hard until recently. It's completely softened up, and 2 years from now, it will be the loosest credit market of all time, I can guarantee you. In fact, 6 months from now, everything from the Banking Commission will be unwound.
Yeah.
We'll talk about that in a moment. But by APRA stepping in and slowing the creation of credit to a point where literally 80% of demand in the Australian property market stopped, where we went from 30% or 50% of properties being bought in Sydney and Melbourne from international investors, now at 7%, where we went from 40% of properties around Australia being bought by investors to now less than 25%. All of these things meant we put a halt. Imagine property prices had continued to go up since 2014 or 15 or 16 by another 10 to 15% per year like they were, how uncomfortable things would be feeling now. But thank God, between 2014 and 17, the series of policies resulted in one of the largest and longest property market downturns since the 1980s. It was actually the most severe downturn in Australian prices in 35 years.
It's really important to know that Australia's property market has already gone through some really tough times in recent history, and that's probably why Eliza doesn't believe, well, is kind of alluding to the fact that this may not affect the property market.
And we have no idea.
We have no idea.
I think it's going to affect some property markets. Particularly, there are a bunch of people that said to me that they would like to get started immediately and pay us for our service. And for those particular people that I thought weren't in a strong enough position to do something, I just flat out said no. For other people, like there was about of the 8 people I spoke to yesterday, 5 wanted to get started and 3 of them will get started in the next week or 2. Those 3 people were in very safe positions with good equity, good savings, good cash flow, good security in their industries and their jobs, with good safety nets in place. So, we want to do everything we can to possibly protect people. We want to see you thrive, but we don't want to see you get burnt, or we don't want to see you put everything on the line to get into the property market. Now, there are going to be absolutely deals everywhere at the moment. And, the last thing I wanted to touch on is a lot of people have diverted back to a let's wait and see approach. Brendan Kelly, who's another analyst, talks about this in an article that I got from him this week as well. Now, I wanted to talk about this wait and see. Now, I've been investing in property myself since 2011. Now, between 2011 to 2013, I saw a wait and see approach because we'd just come out of a GFC. The excuse was, we've just come out of a GFC, I'll wait and see if it gets better. Then between 2014, 15 and a bit of 16, we saw the biggest boom in the last 10 years, not in history, just the last 10 years.
But it was still a boom.
It was a boom, and we saw people freaking out. And during that particular period of time, I heard people say, I'll wait and see if prices come down because they can't keep going up like this forever. Then I saw in 2016 an Australian federal election. So everybody said, I'll wait and see what happens after the election. Then in 2017, I saw
old mate on the news, 60 Minutes.
Yeah, on 60 Minutes come out and say that he believes that within the next 3 months to 6 months, we'll see Australian property prices decline by 60 to 80%. And I saw everyone say, well, let's wait this year and see if that happens. Then in 2018, I saw APRA step in for the second time. The first time was in 2016 and say, we're going to make it really, really hard to access credit. And people said, we'll wait and see if it has an effect on the economy. Then in 2019, we saw another federal election and people were worried about Labor getting in and cutting negative gearing. And they said, we'll wait till after the election. And then in 2019, we've seen people say, well, we'll wait and see about the coronavirus. Now, over that 10 years, while people have been waiting and seeing, I've personally invested in 12 properties. I've sold 8 of them now. I've worked towards my financial goals. I've started businesses. I've set my family up for their entire future. And I've listened and listened and listened and listened to people talk about waiting and seeing. And I fully get it. Like, I fully get that there's always going to be a reason to stop you doing anything. I'll listen to it all year. Like I listen to it on all of our channels where people are saying different things, and that's completely cool.
You want to keep your finger on the pulse.
You want to keep your finger on the pulse, but you want to, I get that a lot of people need to wait and see right now because they're in a tricky financial position or they're not in a safe position to do something. Myself included, like for the last few weeks, I've been trying to figure this stuff out, and that's why I've been so deep into this. And this is a much more analytical podcast than you're going to get from all the other fun content we're creating. But, just don't be that person that sits on the sidelines for the next 20 years or between your 20s and 40s or between your 40s and 50s and wait and see, because you're never going to have a better opportunity to buy a stock market than when it's down 40 to 50%. You're not going to have a better time to sit on the sideline to buy property, at least in the last 10 years in Brisbane, than when it's at the bottom of a low, when there's an undersupply of available accommodation and when a lot of people are sitting there going, we'll just wait and see. And, we will wait and see. And what I can tell you is going to happen is that within worst case scenario, 18 months to 3 years from now, this will unfortunately all be over. And all of this petrol that the government's throwing on the fire through printing money, through stimulus packages, through dropping interest rates, through making credit easy and making all the banks absolute sluts again and giving money to everyone. And that's what's happening. We'll wait and see what that does to your asset prices down the line. And, you can pay retail for anything. A lot of people were paying because stock market went up by 15% last year. I heard my mum and dad say, I told them to get out at the start of last year, the middle of last year, and the end of last year, and they both said to me, well, the market's gone up by 15%. You don't know what you're talking about. And I said, I don't know what the hell I'm talking about, but Ray Dalio does, Warren Buffett does, Phil Anderson seems to. And if their money's not in the marketplace, then mine certainly isn't going to be. And unfortunately, now they've both lost 40% of their super funds, soon to be 50%, and maybe even worse than that. Now, that is horrible to say, and I love my mum and dad so much, but people do the absolute opposite of what's essential at the right time. Now, I don't want to be preachy about this, and I don't want to sound like an arsehole who's insensitive. It's an incredible opportunity for some people, and that's what I'm trying to pass on, but not for anyone that's in damage. So as always, stay safe, invest with confidence. If you need to sit out of the markets for 2 or 3 years, do that. I don't want to see anyone get hurt financially through this period, but for some people, this is a insane opportunity, and I really want to help you take the most of it by actually figuring out the fact from the fiction and carefully taking one step at a time. We're not talking about buying inner city Brisbane that's gone up by 80%. We're talking about buying the suburbs a little bit further back, on the beach, quality stuff that hasn't really moved a dime for 10 years, with great cash flow that we'll talk about in future videos, that is well positioned for 15 to 30 year growth, that will look like this over 15 to 30 years. Bumpy ups and downs, but a long-term projection of being solid.
Well, thanks, Ben, for breaking all of that down. You probably need a glass of water, bro. Your voice would be crazy after that. But yeah, there's lots of information in there, positive and negative, and I guess over the next couple of weeks, just take it as it comes. Listen to more credible news outlets, and if you're feeling like you want to have a logical chat to someone, obviously Ben and I would love the opportunity to talk with you and help you navigate through these times if we can.
Yep. So just jump over to www.pumpedonproperty.com. Let's have a chat. Whether you do something in the next few years or we just talk about your plan over the next 5 years, it's completely cool. We're here to help. As always, we don't know what's coming next. We're just trying to interpret it the same way as you. And we'll continue to update you as we get updates as well.